We were having a conversation, I don't know if it was earlier this morning or yesterday, about whether bad news is really good news, that sort of Goldilocks scenario. You have some questions about that and some doubts about that.
I do. I think the markets are going to have a hard time really charging higher here because we are in this Goldilocks scenario where the markets are expecting 3 to 4 cuts by the Fed, number one. And number two, they're expecting this really favorable trade resolution. And I think those are two risks out there that aren't really adequately priced in. It seems like the Fed is going to have a really hard time living up to the expectations of the market. You know, before the prospects of tariffs against Mexico came up a few weeks ago, the market was pricing in 1 cut for 2019. The tariff threat against Mexico emerges. All of a sudden, the market goes to 3 cuts. Well, now that threat is off the table for now, at least for now. And the market's pressed its bet and said, well, no, we actually want 3 to 4 cuts. And I just don't see that much urgency or that much of a problem for the U.S. economy that the Fed's going to have to act so aggressively. So I think that's one area where the market's going to be disappointed. And then secondly, on trade, you know, not only is Mexico sort of still this like opaque thing where we don't exactly know what the goals are, but we have to worry about the second order effects against China where you know, China's now retaliating in ways that the United States had never even envisioned. And I think that raises some risks there.
Like what?
Well, you know, when China, number one, put companies on a watch list a couple weeks ago, and then number two, they advised their tourists against travel here in the United States. And China's the number one spender for tourism dollars here in the U.S. I think Chinese tourists spend on average about $36 billion a year. Number two is Canada, where Canadians spend about $22 billion. So it's a pretty big spend, where that puts a lot of hotels and restaurants and things like that at risk.
We've heard that from some of the hotel owners.
Yeah, and I don't think those things are really priced into the market. The market's just saying, well, all this is going to work out and it's just all going to be fine. And we know that because we're up, you know, almost 17% year to date. We're trading at about 17 or 18 times earnings, and we don't have the earnings growth. So if we don't have earnings growth, what's really driving the market higher? I think it's the expectation that all these things are just magically going to work out.
Well, how much of it is where rates stand right now? How much of it is where rates would have to come down to make prices look attractive at these levels? I mean,
in other words, you can get some multiple expansion if you get that Fed funds rate lower, and I think a lot of that's been priced in. We've gotten about 1 turn since Powell's announcement last week, and so that's been sort of priced in. I think we're 1,400 points higher, but I very much agree with Joe. The problem is it depends on the timeline we're talking about. Can you get a tradable rally if the Fed indeed does and throw more stimulus on the party? Perhaps. I'd be skeptical even of that, but I think that's possible. But in the intermediate term, it is mystifying to me what people believe is going to be the end here. Like, at some point in time, do they not think we're going to have to normalize, take away that punch bowl? And I don't think that's priced in at all as you look out maybe 12, 18, 24 months.
Look, when you hear what Mario Draghi is saying today, maybe you think that punch bowl getting taken away is a much longer kind of trip than we may have thought even a month ago.
Absolutely. I think they're actually following our precedent, and then we're going to be following theirs.
But we're kind of tied in with them.
Very much. And there's no exception to this. Once you go to extraordinary monetary measures to stimulate the economy, which may very well be what they needed to do post-financial crisis, but when they didn't begin steps towards normalization in 14, 15, and really even in 16, when they kind of chickened out during that spook in January in the markets, the fact of the matter is that at some point this has to be normalized. They didn't quite get there. I agree he went a bit too far.
If the economy's slowing, what would you tell the Fed, what advise the Fed to be doing right now?
Well, I can answer that, but the problem is, Becky, that when they do cut late cycle versus mid cycle, it doesn't have a stimulative effect historically. And so I think that they end up pushing on a string. I most certainly think that's what Draghi faces in Europe. And so, unfortunately, sometimes what they maybe need to do is nothing at all.
Joe, really quickly, what would you tell people to do with stocks?
You know, I think over the next 6 months, we're going to see volatility. I think the risks are the downside. I would be a buyer in any amount of that volatility. And the reason is because I don't think this is the end of the cycle. This is not the end of the bull market. It's not the end of the economic expansion. I think this will look like a late cycle pause. But the things that cause recessions here in the U.S. are just not anywhere near on the radar. You know, the two things that will drive a recession in the U.S. are, number one, when businesses overinvest, where they become too confident and deploy too much capital. That's not happening. And secondly is when you get like wealth destruction, when you either get a drop in home values or a significant like bear market in equities. That's what causes recessions. Neither one of those are on the horizon. So I think any amount of volatility or any setbacks we get in the market, I actually think is a viable opportunity. It's just that up 17% year to date when earnings growth is flat or even at risk of turning negative is a clear warning sign.
We do have an election coming up.
Yeah, and
Bernie's up by 9, supposedly.
Yeah, and
you don't think that might cause a little bit of a problem in the equity markets and the economy in general, or no?
Well, perhaps in the mid part of like next year and beyond, but
that's not that far
right now
off.
I don't see really any effect there because it's just all.
Bernie Sanders being the president of the United States would be terrible for markets. Bernie Sanders will not draw the market lower because Bernie Sanders is not going to be president of the United States.
Okay. All right. Yeah. Well, that's what George Clooney told me about Trump. So
this is true. Right. Am I Clooney in that analogy?
Yeah. You are. That's pretty good for you.
Thank you.
Yeah. You're welcome.